If you are watching this video right now, congratulations. That means you truly want to learn, and I am here to help. So without any further ado, let's get straight into business. All right, so now this is a trade I took on 25th of March, is it, or 24th of March? I took this trade on 24th of March. Today is 26th, which I'm making this analysis. All right, and we have the chart like this. It was a short and a long, one hitting TP and one hitting SL. Right, but I'm going to scatter everything and then we go over it all over again, so I can teach you guys how I took this trade, why I took this trade, and how to remain profitable in trading supply and demand. So let's remove all this like this, and you'll see we'll still end up this same way. This chart will end up remaining like this, but I'm going to delete it first and then remove 10 drawings. Boom, there we have it. All right, so now the first thing you want to look at whenever you are trading, okay, any strategy, all right, any strategy, you want to look at the whole market structure. And for me, I make my analysis on the 15 minutes time frame. So you want to look at your whole market structure. How has the market been moving? How? Look to the left. Just like whenever you want to cross the road, you want to look at, okay, you can see last week Monday, we had on the 17th, we had an uptrend. The market has just been riling up on gold, riling up until it got to this point where there was a break of structure to the upside and then a last buy candle before we started seeing the fall on gold, and it kept falling like this, consolidated a bit, fell again, and now this was a sharp fall. Now if you trade supply and demand, you always want to look for a point in which the market did a massive buy up or a massive sell down. That is where we are looking forward to capitalize on. So you will not want to be capitalizing on little chunks of moves like this, or no, you want to be looking forward to taking that strong move, you understand? Because when there is a strong buy up or a strong sell, that place, that region tends to really be valid to trade off with. And when you trade supply and demand, that is what you're looking for. That is the best thing you want. So that being discovered, you move on, then you can mark out your analysis. Okay, the time frame I use is 15 minutes time frame. I use 15 minutes time frame because it gives me a clearer picture of what the market is doing, rather than going down to mark my analysis on the 5 minutes time frame or that. Those lower time frames, I use them much more for determining my entries and not to mark out analysis, because most of the time the higher time frame is where the big deal is, the main deal is. This lower time frame is, most of the time is noise. So I'm not saying you can't trade up the lower time frame, it is, but especially in your beginning journey, you really want to avoid it, except for entries. All right, so now we have that marked out. So I'm going to zoom this in like this. I'm zooming this in like this so you guys have a clearer picture, and we can navigate through this together. All right, so what can you see here? This was an alert I set. I have to delete this now. It already triggered, but I just set it again. Let's delete this. All right, so what do you want to do? You want to mark out your first sell, your first buy candle before the massive sell down, and as you can see, it broke structure. Okay, this was a change of character. Now I use 2 indicators in my chart because I don't like having so many indicators that just doesn't make any sense. You see some people moving average, RSI, this, that, this, and then it's just clouding their whole chart. You can't actually see price action by your naked eyes. So the 2 indicators I use, don't worry, even if you don't see it in this video, I'm going to drop it in the description below. So the description of this video will include the indicators I use, which is SD Boring Explosive for marking out supply and demand regions. Then we have the BOS and the chalk, both by Nephew Sam. What the BOS and chalk does is it shows me every break of structure and change of character, fair value gaps, order blocks, whatever it is, you name it, in supply and demand that you might need. So I do not select all, I just select the break of structure, the change of character, and the fair value gaps. Moving on, so you want to mark out your last buy candle before your huge sell, because that is going to act as your supply zone. Okay, which means when price gets to that point, you are looking forward to taking a shot from there. So what do? you mark it out like this. All right, and then here we go. This is our supply point of interest, so I'm going to name it supply point of interest. Why am I calling it a point of interest? Because I am expecting price to react at this very point. You never can tell what the market will do. Okay, it's not a certainty that okay, definitely price has to fall from this region. No, it simply means price should react from this region, considering the fact that there was a huge sell around this region. So we are expecting a kind of reaction. That's why it's a point of interest. So you can call it your supply zone or your supply region or whatever. Now, that being marked, if it was a long, don't worry, we'll do the same thing. That being marked, you want to look at the last point in which price dropped to before rejecting up and started going back up. So this here, right here, is the area of it. That is the last point in which the price dropped. So you mark that out again. Okay, you mark that out as your resting liquidity. Mark that area out like this, name it your liquidity, which means price respected that region and bounced back up, never went back there again. So you can see it here. So I believe everyone is following up till this very point. We've marked our supply point of interest. We've marked the resting liquidity in which price dipped to that point and then respected and rejected up, creating a new area of demand at this point, which we are now going to mark as our demand region like this. Okay, mark this, change the color, so then name it the demand area or demand region, anyone you want to call it. Let's name it demand area. Good. So now we have our point of interest, we have the newly formed demand area, we have the point of resting liquidity. Now what do you do at this very point? Because trading is most of the time you just do your analysis and then you exercise patience. You exercise patience for the market to play out. You don't want to be in and out, in and out, in and out every single movement. So now at this point, what you do is you just set your price alert at this point. Okay, you set your price alert at this point and wait for price to get back to that point for you to do anything, be it take a short or you might avoid the trade depending. Now we have two types of traders. If you watched my previous video, I explained we have two types of traders. We have the trader who drops his makes his limit order down according to his analysis. Okay, let's say you are this kind of trader. It's not a bad way to trade. It might be a good way to trade from the very beginning, right? Rather than going into the complex way of looking for change of characters and all. Over time you can become that way, but I started like this. So let's say you have your supply region like this, and then you move your stop loss. You put your stop loss at that high. Okay, this high that swept liquidity before the downward push. You put your entry at the last buy before the sell, and then targeting a 1 to 2 risk to reward ratio at least. Okay, so let's say you did it this way and you set your limit order like this. After marking this analysis, what would have happened? You see, price will have come, tapped your entry, respected that, and then hit your full TP, clean and easy. Okay, this is just supply and demand. Price got back to that region simply because that region was strong enough. There was a massive push downward. It was massive. There was a massive push downward, and then there was a change of character to the downward side. It also had a fair value gap in the move, so it will hold. Definitely. Do I mean that it's going to hold 100% of the times? No, but most likely 80% of the time it will hold. All right, so you place your order like that, and then you have it there. You have it as your clean trade. So let's look at it from let's look at it from the second trader aspect, which is the one who uses change of character to enter. All right, so now we have our first trader who set his limit order. This is the simplest way to trade supply and demand, the simplest way to do it. Just mark out your key levels, look at everything, and then you can set your limit order down. That is the simplest way to trade. Okay, now if you want to go to the more advanced way, is by using change of character. So what happened, we want to wait for price to get back to this point of interest, here, and then see how price reacts. So price tapped this place. If you set your alert, which is what I personally recommend, you set your alert so you don't have to be looking at the chart all day long. No, you did your analysis on Friday or Sunday night. Let's say Sunday night, you did your analysis while the market was still here before it opened for the new week, and you will see that it didn't take it took a while. All right, it tapped on Monday, but it tapped around 10:30, yeah, there about 10:30, around that time. So are you telling me you'll have been sitting in front of your chart from Sunday until 10:30 looking at it for price to get back to that your point of interest? No, you just set your price alert and then go around doing your whole day. Because why are we trading? We are trading for the freedom, right? We're trading to make money with our freedom. So you don't want to become a slave to the chart and always being on the chart. Make use of these things that TradingView has given you, like price alerts, and you'll be good. So now price tapped into this point. Okay, price tapped into this point, and what happened? It started falling off. So we had price tap into this point and then it fell off. Now I want you guys to observe something. There is one thing I normally tell people that normally trade fair value gaps. I'm not against it. Each person has their own way of trading. But now let's say we had those who wanted to go short from this fair value gap here. So what happened? Price tapped into this fair value gap like this. I'm going to mark it out. Price tapped into this fair value gap like this. Okay, I'll change the color like this. Price tapped into this fair value gap. Let's adjust it. So quite all right, price tapped into this fair value gap and respected it. It came down. So that if you were looking forward to taking a short from this fair value gap instead of the actual supply point of interest, what will you have found out? You see that price respect your fair value gap, went down and come back to stop here. It's going to knock you out, to hit your SL and knock you out. So avoid trading fair value gaps, at least not on the 15 minutes time frame. You might do that on maybe the 1 hour, the 4 hour daily time frames, but 15 minutes time frame, please use the real demand areas or the real supply areas. Just have the fair value gap can be a confirmation to be like, okay, this value, this point of interest should hold because it had a fair value gap at the beginning of the move, maybe the supply region or the demand region. But do not try to enter using the fair value gaps of that region. Most of the time it's going to break it. So now you see it went in to tap the real actual supply region before the true move downward. It might have looked as if it was going downward after tapping this fair value gap, but you see it went again with strong momentum, tapped it and then went down. So now at this point, let's remove this. So now at this point, as a supply and demand trader who uses change of character, which is smart money concepts, to derive their entries, their stop loss and all, which I do, like I said, the beginner's way is to trade by setting your limits order down. Over time, you can transition into the second aspect, which I'm explaining. So we have the change of character. Now we want to look for a change of character in our point of interest, since price has tapped our point of interest. Okay, so this is the 3 minutes time frame. This is the 3 minutes time frame. So now you're going to be using the 15 minutes for your analysis and the 3 minutes for your entries. You might use the 1 minute, but I personally don't recommend the 1 minute for if you are really new into trading, because the 1 minute can really be noisy and you get confused. So now what happens? Look at it on a 3 minutes time frame. Let's make it bigger a bit. All right, cool. So look at the 3 minutes time frame. Price tapped into this supply region the same way it tapped in on our 15 minutes time frame, right? That's correct. And then it started going down, and it formed a change of character. What is a change of character? A change of character simply means that we are having a shift. Okay, the market is taking a turn. If the market was going up, and then you see a change of character to the downward side, it simply means that, okay, now this uptrend is over. We are going now into the downtrend. So this change of character was the confirmation you were looking for in order to be sure that, okay, this supply region actually holds, and now we are going to be going downwards. So the moment you see this change of character, then you can enter the trade to go short. Unlike the other one who has, by now the other one who had set his limit order is already in the trade. That's quite fine and good. But if you want extra confirmations by using change of characters, now you've seen your change of character, you can enter. Now this is what I used to tell people to avoid getting trapped by change of character. You don't want to enter every single change of character you see on the chart. Because you see a bullish change of character, you enter long. You see a bearish change of character, you enter short. No, your change of character needs to be in line with your point of interest, be it your demand area or your supply area. Your change of character has to be in line. Very important, take note, it has to be in line with your point of interest. And as you can see here, this change of character is in line with our supply region. So it tapped the supply region, went down before forming the change of character. Unlike this, look at this, we have bullish change of characters here. There's a bullish change of character, and then the market was going up. Bullish change of character, the market was going up, only to go up a little bit and then come down again. So that means if you took a long like this, you will hit your stop loss, because this change of character is not in line with any key levels, probably an inducement zone. So it's not really in line with any key levels. You want to avoid it. So moving on back to this, we have our supply region that was in a change of character that was in line with our supply region. Now, how do you take the trade? How do you take the trade? What I personally like to do is I like to enter at the last buy before the sell downwards. The last buy before the sell downwards. Look at it here. So where will your stop loss be? Your stop loss is going to be at this fractal high here. That was the highest point in which price went and then dropped down. So you don't expect price to go back to that point again. So you set your stop loss there, set your entry at the last buy before the sell, which is the freshly created area of supply, and then target a 1 to 2 risk to reward ratio like this. And there you have it. There you have it. So look at it here. Price, formed that change of character, went back, tapped into that supply region, came down, form a break of structure. Now a break of structure is simply a confirmation. So the break of structure always comes after the change of character, which means the change of character is signifying, okay, the market is about to turn. It's a signal. While the break of structure is a confirmation. So break of structure comes first. Sorry, the change of character comes first, then break of structure comes after. So the change of character is signifying you that, okay, the market is about to turn. And once you see a break of structure in accordance with that change of character, it simply means it's a confirmation, yes. But most of the time you have to enter at the change of character, because sometimes once it forms a break of structure, it's not going back to tap your entry. The market has gone and left you behind. So after this break of structure here, what can you see? If you wanted to enter at this point, you can't enter again. The price went back up but didn't tap you again, because now the confirmation of the downward trend has been formed after signifying. So you need to just enter at the change of character, tap you in. Once you saw a break of structure, you saw a break of structure again to the downward side, and then we hit our full TP. Look at it on the 15 minutes time frame. So this is how it played out. You tapped into this, stop loss at this region, price never went back there, and then it went down. And as you can see, some people normally target the whole move, trying to enter into that demand region back. So you can say you want to put your TP like this, so it will be around a 1:3 but I just personally like to keep my trades at 1 to 2 because it's profitable for me. I love a system of high win rates and then a lower risk to reward ratio. Doesn't mean I'm trading 1 to 1, but at least most of the time I hit my full TP. And as you can see, this is how the trade played out. Now we are not done. I know if you've been enjoying the video so far up to this very point and then you gain something valuable, please hit that subscribe button and hit the like on the video. So that helps me a lot, and that just makes me understand that, okay, what I'm doing here, people are loving it, and I'll keep doing things. I'll keep releasing more videos like this, teaching you guys how to trade supply and demand, and in general make you a better trader. So now we want to look at this. Price came to these very points here. I took a long actually, price came to this demand area here and rejected, signifying that okay, it respected this point. So price came here, rejected, and then I saw a bullish candle or a bullish candlestick to the upward side. At this point, I was happy to take a long. This is it here. I was happy to take a long. As you can see, this is a fractal low. We have a change of character to the upward side. So this is how you take the trade. Now, this is the reality of trading. There is no strategy that is going to work 100% of time, right? It's not possible. But you can always make more than you lose. Just like the way you saw this thumbnail, there was a win and there was a loss on that very day. So I set my stop loss here like this, and then my entry at the last buy before the sell, or the last sell before the buy, in alignment to the change of character. And what can we see? Targeting a 1:2 risk to reward ratio like this. All right, let's just put at this, and as you can see, price tapped me in, but it never went to my full TP, and I ended up getting my stop loss hits, which means I made a 2R on the short and lost a 1R on the long. But overall for the day, I was still profitable. As you can see, this is it on 15 minutes time frame here. So yeah, the price is now going back up. Price is going back up. I'm definitely going to observe the market and look for any new entries I can take on gold, or mark out my point of interest and all of that. But now the point I'm trying to pull out from this video is there is no system with a 100% win rate, right? It's not possible. You can have a 80% win rate. Most of the time it works out, but that is now the remaining parts to profitability is left to you, which means you need to have discipline, you need to risk the same amount per trade, and you always need to not get too excited after a winning streak or a losing streak at the same time. So which means, for example, let's say I took a shot on this, I risked $100, I made $200, as you can see in the thumbnail. That's a 2R. Doesn't mean now because I want to take a long, I'm now risking the whole $200, because man, if I can risk the whole $200, I'll make about $400 in profit. No, I'll just end up losing the whole $200 that I made for the day, right? So you want to be taking at least 2 steps forward, 1 step backward in your trading journey, and you will be profitable overall. So I hope this video was of value to you guys, and I'll see you guys in the next one. Peace out.